The second important financial statement is a balance sheet. The balance sheet is also called a statement of financial position. It tells us that the financial position of the business, whether a business is highly leveraged by external debt or owner's money into assets. So when you prepare the balance sheet, your concentration should be on the asset side, and on the liabilities and equity side, what portions of liabilities and equities occupied in the assets. Means whether the assets are purchased by external funding more or owner's money more. Anyway, first of all, how to prepare balance sheet? A balance sheet is to be prepared according to liquidity. Means liquidity means how fast you get collect from the assets. Some assets are converted into cash fast, but some assets from which you cannot expect any cash. In fact, we use them in the business to run the business. The assets which are transformed into cash in due course are called as current assets. In the order of liquidity, I mentioned the current assets as CMAIP, that is cash and bank balances, marketable securities which can be converted into cash like fixed deposits, we call them as certificate of deposits. Accounts receivable means our credit customers. Inventory, which includes raw material, work in progress, and finished goods in the case of manufacturing company. Finished goods in the case of trading companies. Prepaid expenses or prepayments or the amounts which are paid in advance for the future period. The total of current assets will help us that what amount of liquidity we are maintaining. Liquidity, not liquidation, please. Liquidity. The amount of liquidity you are maintaining to meet the current requirements can be known from the total of current assets. Then non-current assets tell us the amount of fixed assets we have in the business. In case of retail industries, you will have more assets in current assets, like inventory portion will be more. In the case of manufacturing industries, you will have non-current assets portion is more, like non-current assets include plant, machinery, land, etc. In case of manufacturing industries, you will have plant which is high valued asset among all the assets. Therefore, we can say that in case of manufacturing industries, the non-current asset portion is higher. In case of current assets, short-term assets are higher. Non-current assets are again classified into tangible assets, which include land, plant, property, equipment, vehicles, furniture, etc., etc., whose value goes down as we use in the business as the period passes by. Therefore, we charge depreciation on those assets. Intangible assets are those which do not have any physical substance, means they do not have any physical existence. They are the rights, they are the reputation we buy from the owners of the rights, and we buy them for a certain period. Therefore, they will have some lifetime, like patents. We buy them for 5 years, 10 years, like that. So we become owners by buying the rights from the original owners for a certain period. Therefore, during that period, the amount which we pay to the original owner, is to be absorbed year by year, which we call it as depreciation. But the word which we use, depreciation, okay, this is to be used for only the tangible assets. In case of intangible assets, the same depreciation is called as amortization. So in the balance sheet, always you need to have the carrying values. Carrying values are the values from which, from the original value, when depreciation is deducted, we call it as carrying value. So here carrying value of the asset equals to historical value, means at what price we historical value minus accumulated depreciation. Accumulated means the amount of depreciation each year. Okay, accumulated. Say for example, we purchased an asset in 2013 for $10,000. Yeah, depreciation. Depreciation for 2013 is say 2000. Depreciation for 2014 it is 2000 again. So the accumulated depreciation here is 4000, and the carrying value will be 6000. Always this asset is to be shown at its historical value in the balance sheet in here. But this depreciation, accumulated depreciation will be deducted at the bottom and it will show carrying value here. When you compare the carrying value with the current market price, you will see whether there is a gain or loss on asset value. Or when you sell this asset, the sales value and carrying value are compared so that we can know that there is a gain or loss. Say for example, this asset is sold for 5,000. There is a loss of $1,000 on the sale, which is a non-operating loss because this is not our nature of the business. Same time, say if I sold it for say 6,200, I had a gain of $200. You should not say it is a profit, it is a gain. Okay, so carrying value is used to find whether there is a loss and what is the value of the asset as on the day, whether there is a loss or gain on disposal of the asset. Next, we move on to liabilities and equity. Liabilities are again classified into current liabilities and long-term liabilities based on their due in the business. A liability which is due within an operating cycle means can be a week time, can be a 10 days time, can be a 15 days time, maximum within a year, is called current liability. In most of the organizations, especially in retail industry, accounts payable plays a key role in the current liabilities total. Means you will have heavy amounts in accounts payable, nothing but sundry creditors, supplier balances, supplier balances, okay, from whom you purchased goods on credit. Accrued expenses are also current liabilities. Accrued expenses are those which are not yet paid. Say, for example, September telephone bill not yet paid, because in the first week of this month we will get the telephone bill and we pay them for September. But as far as September is concerned, the expense is not paid, so that it becomes current liability. Incomes received in advance or any amounts received in advance. Say, for example, um, you received an amount of advance from your customer for which goods will be delivered in the month of November, but you received today. Okay, the amounts received from customers or any income of November, December you received now. It's a liability. It will become income in that particular period, but at the moment it will become income. Bank overdraft is a facility wherein bank will create an amount of liability for you to use it. So there is a limit, like depending upon the size of your business. Say a bank gives you an overdraft facility of say 2 million. It means that you can use the bank's balance up to 2 million. Your account will go into minus up to 2 million, and the bank will charge you on the amount used. In a month, you might have used 20,000. Next day, you deposited, say, for example, 25,000. Again, you will have a positive balance of 5,000. After 1 week, again, you used 30,000. You will have a minus balance of minus 25,000. And this has gone for 10 days. So, whatever the minus balance is there, on which interest will be calculated for the days you have. It's a current liability because it goes up, down on time, time based. Short-term loans, banks also give term loans quarterly, half yearly, etc. So those term loans are to be repaid within a financial year, within a period of 12 months is called as short-term loan. And also current portion of long-term loan will come under current liability, which means, say for example, in 2013 you took a loan of say 10 million, 10 million, 5 yearly installments of 2 million. So in 2013 you have to pay 2 million. 2013 you have to pay 2 million plus interest on 10 million. 2014 you have to pay 2 million plus interest on 8 million, reducing balance. 2015 in the month of December you are going to pay, for example, 2 million and the balance of interest on 6 million. So this 2 million will become current liability here. And after the payment of the 6 million, now the balance here is 4 million, which will go to long term loans. Current portion, what is the current portion? That will be shown in the current liabilities, and interest will go to anyway income statement. Do not think of interest here. If not paid, it will become current liability as an accrued expense. Okay. Long term liabilities, this is a part of debt which will be paid in more than a year period. Mostly these are all rate of at least a period of 3 years or 5 years borrowed. Why? Because most of these amounts are borrowed to acquire fixed assets, because fixed assets will give you returns in long period. So you'll have to borrow money long period. As all, you also know that the fixed assets will not give you cash, but they will give you service. Therefore, these liabilities can be paid only in a longer duration. Therefore, you need to borrow the money for longer duration, like 3 years, 5 years, 10 years, like that. Say, for example, you can buy a mobile phone. You can buy a mobile phone by using your credit card, which you can pay next month. But you cannot purchase a house using your credit card or personal loan. Why? Because that amount is not sufficient to pay this off. So that you opt for like 10 years, 15 years loan. So mostly what I mean to say is, mostly all the fixed assets better to borrow to or to be arranged by borrowing in long term. Never, never, never use bank overdraft to buy a vehicle. Never use short term loans to buy or land. Why? Because this will become due by next month. This will become due by next quarter, or maybe by the end of the year. By the time land has to produce some revenues or cash flows to pay them off, which is not possible. Therefore, long term debts are to be used to acquire fixed assets. Yeah. In equity, equity is also called as owners funds. In this I give you like super 6, which means we have 6 components in this maximum. There are 2 categories of shareholders: preference shareholders and common shareholders. The amount generated by issuing the preference shares is to be mentioned in preference share capital, giving the details of the title, like 8% preference shares, 8%, I will write here quantity also, 8%, 10,000 preference shares of $100 each. This is the title. Here 8% 10,000 preference shares of $100 each. She gives you complete picture of this amount. Means we have 10,000 preference shares issued to public. Each is $100. So 10,000 times 100. 10,000 times 100 will give you how much? It will be 10 million, 1 million, $1 million. So you will write $1 million here. And this description you will have to write here so that the external parties know very clearly that 8% of $100 will be paid annually to 10,000 shareholders. And the amount which we collected from them is 1 million. When you sell this share, not for 100, for 105, it is called as paid in excess of par, means premium. Paid in excess of par. Say for example, you issued these shares, okay, at the rate of 105, so 10,000 shares times $5. This is to be recorded here immediately after the preference shares. So 10,000 times 5 will give you 50,000. We call it as premium. Here it is called as paid in excess of par. Par means face value. Face value means the registered legal value of the share is called as par value. Here it is $100. Even if it is sold for 105 at a premium or 98 at a discount, the dividend is to be paid always on par value. So the preference shareholder will get 8% of $100, though the share is sold for 105, 100 plus 5 premium. Always dividend is to be calculated on the face value of the share. Here, common shares. Common shareholders do not get any fixed dividend. Therefore, you should not mention any dividend portion. And say for example, we have 50,000 shares of $100 each. So here you will have 5 million. These are the equity shareholders in India. We call them as common shares. Common shareholders. They do not have any fixed dividend. Whatever the amount of profit is arrived after paying interest to debt holders, dividend to preference shareholders, the left will be paid to the common shareholders as dividend. So common shareholders are the gainers and common shareholders are the losers. Okay. Then when this share is sold at the rate of say $2 premium, you will have a paid in excess of par as well. Paid in excess of par common shares, and these shares are sold at the rate of say $2 extra. So you have 50,000 shares at the rate of $2, $100,000, $100,000. So these are all to be very clearly mentioned with the details so that any external party dealing with this company knows very clearly from the presentation that there are 100,000, 10,000 preference shares whose face value is $100, that there are 50,000 shares at the rate of $100. And you'll have to present your retained earnings, which is from your income statement. Remember, I gave income statement ending retained earnings transferred to balance sheet under equity. This is the result of your retained earnings statement. So you show retained earnings here. And now treasury stock. What is treasury stock? Treasury stock is the stock which is purchased from the market of its own shares, own common shares. These shares, say, to gain the advantage of the market when the market goes down, or when there is a heavy cash flow in the company, companies are allowed to buy its own shares to some extent, like 2% of shares, 1% of shares, like that. How many shares I mentioned here? 50,000. Say this company is buying back 2,000 shares. So treasury stock will be 2,000 shares. You are buying it back 2,000 at the rate of $100 each. And this amount, 2,000 times $100, should be shown in minus value because it is the amount which you purchased back. Always it should be deducted. Why? Because this 50,000 shares you are showing fully. In fact, you have only 48,000 shares outside. As you are registered with 50,000 shares, so you are showing it full amount here. But from this 50,000, you purchased the shares back. Therefore, this amount is to be deducted because you don't have full 5 million worth of share capital outside, out of which you have around 200,000 share capital owned by our company itself, which is called treasury stock. So remember again, the total of this 5 including retained earnings, say for example you have received a retained earnings of 340,000. All right, from this total of 5, always you deduct treasury stock, which is very important. So treasury stock, these 2,000 shares are not eligible for any dividend because you have only 48,000 shareholders outside. Only 48,000 shareholders will get dividend. So out of 5 analysis, the liquidity analysis plays a key role because a liquidity analysis places the company in a top position because you are maintaining a good liquidity so that your suppliers will believe, the employees will believe, all the operating expenses will be paid on time, so there will be no disturbance in day-to-day operations of the business. Liquidity analysis builds the reputation. Liquidity analysis spoils the reputation. Therefore, you need to have sufficient amount of liquid assets to meet the current liabilities. When you think of liquidity analysis, think of short-term financial position. Short-term financial position means whenever the current liabilities become due, with no waiting, the current assets are to be used to pay them. So we understand that there should be enough current assets to pay current liabilities. So the current asset position and current liabilities position are to be compared here. So you will have current assets here. The current assets, what amount of current assets we have and what amount of current liabilities we have. You have this relationship between current asset and current liabilities is to be studied in liquidity analysis. Current assets you know well, CMA, IP. Cash and bank balances, marketable securities, in accounts receivable, inventories and prepayments. Current liabilities you know, the amount of liabilities which become due in an operating cycle or a maximum period of 1 year. Can be accounts payable, accrued expenses, incomes received in advance, a bank overdraft, a short-term loan, and any a portion of long-term loan is becoming due this year. These need to be monitored from time to time and compared with the current assets, and never allow current assets to go down than the current liabilities. The moment current asset portion goes down than the current liabilities, the company faces liquidity problem. The company faces solvency problem. The company faces problems from the suppliers, problems from the utility companies, from the employees, from the tax authorities. So the company ultimately, if this situation is faced by the company for long period, may lead to the liquidation, bankruptcy, insolvent. The company will become insolvent. This is the reason why the liquidity analysis comes first when you compare with the all and other analysis. Why? Because if you do not maintain liquidity, you cannot expect any profitability and efficiency. If there is no good liquidity, obviously your share price will also be down. So there are all mandatory things that you need to maintain some liquidity, good liquidity. The liquidity can be measured using ratios. What is a ratio? Ratio is one term is a ratio is one term is expressed, one item is expressed in terms of the other. So current assets are to be expressed in terms of current liabilities. Current assets are to be expressed in terms of current liabilities. So this is the reason why we are going to calculate the ratios to know the amount of current assets on the current liabilities. Say here we have a current ratio. Current ratio explains the relationship between the current assets and current liabilities. Means how much current assets are maintained against the amount of current liabilities. Okay, so current assets and current liabilities are the tools used here. We see that how much of current assets are maintained in terms of current liabilities. This can be used with the formula current ratio equals to current assets divided by current liabilities. The standard norm of this ratio is 2:1. 2:1 means 2 times in current assets against 1 time current liability. Say for example, if you have 1 million current liabilities, there should be a current asset of $2 million. You can maintain less than 2 million as well, but when you present your financial statements externally, like your supplier, banker, or credit analysts, it shows that your liquidity position is not good. Therefore, we see that always we maintain this ratio. We call it a standard norm because it is an industry average. Standard norm means industry average. Outside, almost all the organizations maintain a current ratio of 2:1 and has to be maintained at this stage so that the company will be safe in maintaining its current liabilities on time, so that no supplier will complain, no employees will complain, no issues will arise. the non-payment of liabilities because you have a good amount of funds in current assets. So current ratio is the first tool used in liquidity analysis. But as you know that current assets are nothing but the total amount which is there in your liquidity, that is CMAIP. When you say CMAIP, you see some assets will take some time to get them converted into cash, like inventory. Your telephone bill has to be paid immediately, but inventory cannot be expected to be converted into cash immediately. This is the reason why sometimes current ratio may not help you to have an understanding of the liquidity of a company. Why? Because you are giving equal importance to all the current assets CMAIP to pay current liabilities. My current ratio is 2 is to 1, greater than 2 is to 1. But my current cash balance is say for $500, marketable securities 0, accounts receivable say 2,500, inventories 22,500, prepayments 7,000. See, against a current liability of say 15,000. You may have more than 30,000 in current assets against a current liability of 15,000. But as I told you, my inventory value itself is 22,500. My current liabilities are 15,000. It shows you very clearly the current ratio is greater than 2 is to 1. But where is your current invested? Mostly in inventories. Inventory has to become accounts receivable has to become cash to pay current liabilities. So, depending upon current ratio alone, expecting the liquidity may not help you. Therefore, you need to calculate the other ratio called acid test ratio, acid test ratio, also called as quick ratio. Okay, is this ratio is more conservative than current ratio. Means it gives much importance to the liquidity. It doesn't consider all the current assets will be used in payment of current liabilities, in my example like prepayments and inventories, wherein you cannot expect cash immediately. From prepayments you cannot even expect cash at all. Okay, so it in which we will use quick assets to pay current liabilities. Okay, so it explains the relationship between quick assets and current liabilities, not total current assets. It has to calculate quick assets and use them in the payment of current liabilities. So the formula for quick ratio will be quick assets divided by current liabilities. When I say quick assets, do not use inventory and prepayment, please, because they do not bring cash immediately. And the standard term of this ratio is 1 is to 1. Just 1 is to 1 is enough because you have readily available cash to pay your current liabilities. One time in current asset against one time in current liability. 1 million current asset, quick asset, and 1 million current liability. That's more than enough. What are quick assets? So you can say quick assets equals to total of current assets minus inventory minus prepayments. So from CMA IP, deduct I and deduct P, you will get quick assets. So you have to drop those I and P's to pay your current liabilities. It gives you a correct liquidity position because the moment you need cash, you have availability cash. You don't need to worry about the payments because you have enough cash. As long as you maintain a quick ratio of 1 is to 1, you don't have any issues of payment, short term payments. But still sometimes you may have to do some speculation. Means market demands, like your supplier says, okay, your bill is due in November, but if you pay now, I will give you 2% discount. Just paying 20 days in advance, you're getting 2% discount. Means for 20 days alone, you are getting a benefit of 2%. For 200 days, it is going to be 20%. You know, so when you calculate yearly, it will be around 36%. So you are earning an interest or income of 36% when you avail discount like this. Therefore, some companies maintain cash balances though it is not required for normal operations. So usually for normal operations, current ratio and asset test ratio will do. But to meet some uncertainties, unexpected cash requirements, or if the company wants to speculate, say for example, take the advantage of the market. Like I gave you an example of supplier. That supplier is asking you to pay in advance so that he can offer you 2% discount. Else, supplier is saying that if you buy at cash, the price is different. If you buy on credit, the price is different. Or supplier says that if you buy in bulk, the price is different. So you are lifting entire lot at a lower price by dumping the cash. So in that case, your asset test ratio and quick ratios do not help. Why? Because under normality, you are going for these ratios. But if you want to have advantage of the market, you need to calculate a ratio which gives you most importance to the high liquid asset, readily available cash, which is called cash ratio. Cash ratio is most conservative, not even more, most conservative than current ratio, even asset test ratio as well. It explains the relationship between cash assets. Cash assets means cash and readily available cash to meet current liabilities. Means we talk about only cash assets. Therefore, here you will say cash and bank balances, that is marketable securities. Cash and marketable securities over current liabilities. And here it's a cash ratio. Cash ratio equals to cash and marketable securities divided by current liabilities. So you will remove A. See, each ratio is dropping some assets which take much time to see in the cash. Here IP are dropped, it became quick ratio. Here I is also dropped, it became cash ratio. The standard norm of this ratio is you can have around 0.5 against your total current liabilities, because total current liabilities will be paid from accounts receivable after collecting and inventories after selling. But you don't need entire amount of current liabilities in cash balances. How do you? Say for example, you purchased an inventory of $1 million. Inventory immediately the customer is not ready. You'll have to advertise, sell, then you sell on credit, collect it, then pay. Until you collect, that will be in receivables. Only once you receive the money, you will be able to pay your supplier. So you cannot hold lots of cash balances to meet your current liabilities. Therefore, you depend on current ratio. But if you depend on current ratio, certain items are to be paid on time like salaries, utilities, etc. So you calculated quick ratio. These two ratios will work under normality, but sometimes you want to take the advantage of the market, speculation, uncertainties, etc. So you should know that what amount of you know assets, readily available cash assets, you have to pay your current liabilities. That is explained by cash ratio.